Hello, everyone. Thanks for joining and welcome back to Wall Street Bullion. Our guest today is a very good friend, Clive Thompson. Clive has had over 47 years in career and trust in wealth management and Swiss private banking. Clive, welcome back.
Ivan, thank you very much for having me back on your show.
Yeah, thank you so much for coming down. I wanted to get you on. As of right now, June 5th, silver just hit $35 and is going up higher by the minute. How significant is this, Clive, and will it propel higher?
Well, our last show had the title Silver Warning, a warning it's going to go up a lot, or something along those lines. So, yes, it's going to go higher. I think we've broken $35. That was the number that almost every analyst had on their radar screen. They were saying if it goes to $35, I'm loading up. And so I think a lot of people will be diving in. So it wouldn't surprise me if we go past $36 today. And then I think it's probably plain sailing till we get past 30. At what point do we get a pause? Nobody knows. It might just keep going. Let's not forget, back in 1980, and we're talking here 45 years ago, silver was at one point, very briefly, at $50 an ounce. That was because the Hunt brothers had come to the conclusion that the fiat system was going to die and they wanted to buy as much silver as they possibly could. And the gold price was also at an all-time record at that time. It was at $850. So that put the ratio of gold to silver or silver to gold at 17 to 1. In other words, 17 ounces of silver bought you an ounce of gold.
Right.
Well, gold today is let's call it $3,400. So silver would need to be $200 an ounce if we got back to that ratio.
Well, and $200 an ounce would be pretty incredible. Like that would like from where we're at right now, $200 an ounce would be incredible. Uh, what do you think would happen if it doesn't catapult after the $35 silver? Like, do you think we're going to start seeing some? Because a lot of people in the silver and gold market say, oh, there's price manipulation. They're going to just manipulate it back down and they're going to put a bunch of silver contracts out to drive the price down. Do you think they will try some silver price manipulation? What happens to the shorts? What are your thoughts?
There is maybe the bad thing for bulls is there's a lot of above ground silver knocking around just waiting for its price, especially, in coins and bars and knives and forks and candlesticks and God knows what else. And of course, there's plenty of warehouse stocks too. All of it's waiting for its own price. But I think that can easily get overwhelmed by the precious metal buyers.
Right.
And it would do in particular if we have any sort of hiccup or pause in the stock markets. We saw a month or so ago when the tariffs were announced, the stock market took a very heavy dip, and it was almost down to bare territory, which is minus 20%. Didn't quite get there. And it rebounded. And I think a lot of us thought it was a dead cat bounce, but now it seems to be powering ahead, and maybe we're going to go to all-time highs again. But let's say we do get some sort of hiccup in the stock market. People will be looking at that point around for something which hasn't really risen as much. And of course, gold and silver, and particularly silver, are way down in the dumps from their all-time highs. Well, not gold, but silver is way down in the dumps from its all-time highs. And I think there might be some money going in that direction. But what happens if it pauses? Well, it doesn't change the fundamentals of silver. We know that according to the Silver Institute, that the supply of silver coming out of silver mines has been diminishing year on year. And since a few years, the industrial demand and usage of silver has exceeded the supply such that the deficit is getting larger. And the way that deficit has been filled has been by recycling. But we've seen the price, it had to go higher. It's gone roughly from $20 to $30, with $35 now. The prices had to rise to suck out that recycled silver.
Right.
But I can tell you one thing. I deal with a silver and gold dealer here in near where I live in Geneva, and they used to have a lot at $20 and $25 and even $30. They used to have a lot of silver for sale, people were bringing in their coins and so forth because they were disillusioned. Now that supply of stuff coming in has dropped down to a trickle, so much so that they now hardly ever call me. And they know I'm a ready buyer. If they call me and say we've got something in, I'm going to go along and buy it. They're
Right.
not calling. Why are they not calling? Because they don't have it.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
Right. And how do you think, Clive, gold and silver compare as safe haven investments during all this times of economic uncertainty? What do you trust more? Do you trust silver more? Do you trust gold more to protect your wealth, or are they both the same?
Um, to be honest with you, I trust gold more, but I think the bigger gains will come from silver. And I won't exclude platinum as a precious metal as well.
Right.
But again, it's not a situation where you want to be all in on anything. You don't want to be all in on gold or all in on precious metals for that matter. You
Right.
need to be diversified in a lot of things. But the one thing I think you need to avoid, or I would say avoid, you need to be aware of is if you have holdings in cash and bonds, you're going to be going backwards as far out as the eye can see, and you're going to end up at some point regretting that you held these things. Now, at the moment, it doesn't seem to be too dangerous to hold cash or bonds because you perhaps only if we take the rate of expansion of government debt and money supply together, we're probably expanding at a rate of 7%. That will accelerate, by the way, but
Right.
we're probably expanding at 7%, and you've got an inflation rate of maybe well, it depends whether you're looking at the stuff made by robots or whether you're looking at the stuff you might spend your money on when you retire. If there's different inflation rates. So I would like to suggest the stuff you might spend your money on when you retire is probably also increasing by 7 or 8% a year. Nursing homes, luxury cruises, ha having the sort of luxuries that you'd like to have around your home, paying your
Right.
grandchildren's fee, school fees, whatever it is. So if you have cash and you've got an inflation rate of 7 and you're earning after tax maybe 4 or 3%, you're going backwards by several percent a year. Your buying
Absolutely.
power is going backwards. So going backwards by 3 or 4% a year isn't that bad a price to pay for the peace of mind. So many people say, I don't mind that I'm going backwards. At least it's there. I can count it. I can see it in the bank. And I don't want to, I'd get far more stressed if I put my money into the stock market or Bitcoin or gold or silver where the price changes on me every day. I wouldn't feel comfortable with that. And I don't want to buy a property for this reason or that reason. So there are plenty of people out there who quite justifiably say cash is a good thing. And for the mental state, it is a good thing, provided that the rate of depreciation is only a few percent a year, 3 or 4%. But unfortunately for them, that's going to accelerate, and their thinking is going to change. And as it changes, they will be looking for other things to invest in.
Absolutely. Now, Clive, the U.S. national debt is nearly as large as the entire U.S. economy, and it's projected to keep growing. How concerned are you about America's debt, and what do you think are the biggest risks if it keeps rising?
Well, the plan that they have, or the preferred plan, I suppose, is to keep borrowing money from Peter to pay Paul and hoping that that doesn't cause the yield to rise.
Right.
But of course, the yield will rise because Peter is getting indigestion because the level of government debt is rising at a much faster rate than the rise in GDP. So to bring things back into balance, we either need a very big rise in GDP, perhaps to the order of 7%, or we need a large fall in government spending and a rise in taxes. And I don't think there's a lot of enthusiasm for either. I mean, we've seen this bill from the president, in which it's proposed that the tax cuts, which were due to come to an end at this end of this year, will carry on for many years.
Right.
That's not part at the moment. The Congressional Budget Office have not got that in their budget, but it will add roughly $500 billion a year to the deficit. But as it stands without that, according to the Congressional Budget Office, the level of debt over the next decade is going to go from 100% of GDP to 150% of GDP. It's a huge rise in the level of debt. And that's with maybe some rather conservative figures from the CBO. They're assuming there's no wars, no pandemics, no recessions, no sudden crisis. But history says something goes wrong all the time. No banking crisis. Yeah, who knows what will go wrong? But according to the CBO, they've set out their numbers for the next decade, and they assume that nothing will go wrong. And also they assume, and I think this is wrong, to assume it, but they've assumed that interest rates will be about 2.8%, rising to 3.3%. Well, we know that a lot of the government debt is at that sort of rate for historical reasons, but it's maturing, and as it matures, it has to be rolled over at a much higher rate, because the rates at the moment at the short end is 4.6% or over 4%, and at the longer end it's going up to nearly almost on 5%. So unless those rates come down, and I'll tell you why they won't in a second, unless those rates come down, the rate of interest that the CBO has put into their budget projections of 3.3 in the long run aren't going to hold true, and therefore the government will be having a bigger deficit than they're forecasting just on interest rate grounds alone.
Why won't they go down?
Well, at the moment we've got a debt ceiling in the United States since the 2nd of January this year, which means to pay the bills, the government has been basically borrowing, not borrowing big one, it can't borrow. It's been running down its cash balance, and it's been withholding payments to the government pension plans, and it'll make those pension plans whole with interest when the debt ceiling is raised. And I think yesterday or today, our president has proposed that they get not only raise the debt ceiling, but they get rid of it completely, so there is no debt ceiling ever again. Well, that's okay. I mean, that most countries don't have a debt ceiling, so America's kind of an exception by having one. But from an investor in treasury bonds, it maybe was some sort of comfort to the investors in treasury bonds that there's at least up to a point, there's a limit as to how much they can borrow.
Right.
But if they get rid of the debt ceiling completely, there'll be no limit, and that of course means that the supply of treasuries can increase faster and faster as they spend their way to keep the economy rolling along. Obviously, it's very good for the holders of assets like gold, silver, property, equities, Bitcoin, or works of art or heirlooms, anything which people want to own. It'll be very good for that, for the people who've got those things. But for those people who are saving in money terms, well, they'll be going backwards at a faster rate. Just to tell you for the deficit for the current year, now these are my figures, but I've extrapolated them from the Congressional Budget Office's own numbers. In the current year, we're going to have a deficit of $2.19 trillion, 2.1 or $2.2 trillion.
Wow.
And that is the reason that is the highest ever, is because I've got to bring up the numbers in front of me here. Yes, the tax receipts this year are up 4.9% or nearly 5%. Very good. That's in this fiscal year. But the spending this fiscal year so far is running at the rate of 8.9 or 9% higher than the year before. So putting those two together mean that the deficit will be 22.6% higher than it was last year.
Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep stacking. That's crazy.
So what we've got now these figures can get worse or better, but there's no if we do see a slowdown in the economy, that they will get worse because the tax receipts will not be quite as high. But if, on the other hand, Mr. Trump gets all his tariffs in and everybody decides they're going to pay them anyway, well, they might get a sudden amount of money coming in from the tariffs. But next year, we get this extra big hit, another $500 billion added to the deficit, thanks to the tax breaks carrying on if it goes through the Senate.
Wow. Yeah, it's gonna get crazy. And I know like with what's happening in precious metals, of course, like you say, if they get rid of the debt ceiling, it's gonna be good for asset holders. It's gonna be good for anyone who has precious metals. That will be good, but at the same time, removing a debt ceiling, it just doesn't sound good to me, even with like I'm sure anyone who's looking into anything for risk mitigation, that doesn't sound very good.
Well,
Clive,
it's a bit like giving a family who spends more than they earn a new credit card with no limit.
yeah, no, it's crazy to me. Clive, I want to thank you so much for coming down to speaking to the silver and gold community, to speaking to everyone in the investment community in precious metals. I'd really love for people to connect with you. I know you have a great LinkedIn that I recommend everyone to go follow because you post incredible charts and incredible, content about precious metals and the economy. Is that where they can follow you, or is there more places?
Sure, I've just last month started a YouTube channel. It's not really paying me any money yet, but it might in the future. If you look up Clive Thompson on YouTube, you'll find me, and it's basically about teaching people how to invest money. I'm a bit all over the place, but I've been talking. For example, I put in a show a couple of days ago about 14 stocks, which are going to be massive beneficiaries of artificial intelligence, not because they make it, but because they are leading the charge in using it. They are going to save a ton of money in all kinds of costs. They're going to speed up their production, speed up everything they're doing. So their turnover is going to go up, their costs are going to go down, and the profits are going to rise very nicely. And these are very cheap companies with an average price earnings ratio of 14, going on 11 next year. A nice dividend yield. It's more than 5% on average. So a very nice group of companies who are major beneficiaries of artificial intelligence on my YouTube channel under Clive Thompson.
Yeah, I highly recommend everyone watching this. Please go check out Clive Thompson on YouTube. Check out his LinkedIn. I'm going to put the links in the description below so they can connect with you directly. But Clive, such a huge pleasure having you on. Silver hit $35 and is going higher. So we're excited to see what happens next, and I'd love to have you back on in the future.
Thank you very much, Ivan. Thumbs up from all your listeners.
Talk to you soon.